If you've ever felt completely lost listening to people talk about the stock market, throwing around words like bull runs, P/E ratios, and dead cat bounces, you're not alone, and today that confusion ends. Welcome to your complete beginner's dictionary, where we're decoding every essential stock market term you need to know to start your investing journey with confidence. Let's start with the absolute foundation. What exactly is a stock? Think of it this way. When you buy a stock, you're buying a tiny piece of ownership in a company. If Apple has 1 billion shares and you own one, congratulations, you own 1/1000th of Apple. That single unit of ownership? That's called a share. These terms are often used interchangeably, but remember, a stock represents your ownership stake, while a share is the individual unit you purchase. Now, here's where it gets interesting. Companies don't just magically appear on the stock market. They have to go through something called an IPO, or initial public offering. This is the moment when a private company decides to go public and offer its shares to everyday investors like you and me. Think of it as the company's debut on the investment stage. Suddenly, anyone can become a partial owner. But where exactly do you buy these shares? Enter the stock exchange. In India, we have two major players, the Bombay Stock Exchange, or BSE, established way back in 1875, making it Asia's oldest stock exchange, and the National Stock Exchange, or NSE, which launched in 1992 and brought electronic trading to India. These exchanges are basically massive marketplaces where buyers and sellers come together to trade shares. And overseeing all of this? That's SEBI, the Securities and Exchange Board of India, which acts as the market's watchdog, making sure everything runs fairly and transparently. Here's something crucial you need to understand before you start trading. You can't just randomly buy stocks off the internet. You need 3 things: a bank account, that one you already have, a trading account, and a demat account. Your trading account is what you use to place buy and sell orders through a broker, while your demat account is where your shares are stored electronically. Think of it like this. Your bank account holds your money, your trading account executes your transactions, and your demat account stores your investments. The broker is your middleman who facilitates these trades for a commission. They're the registered professionals who have access to the stock exchanges. Now, let's talk about something you've probably heard on the news: market capitalization, or market cap. This tells you how big a company is in the market's eyes. You calculate it by multiplying the current stock price by the total number of outstanding shares. Companies are categorized based on this. Large cap companies are the giants, those ranked in the top 100 by market cap in India, typically valued above 20,000 crores. These are your blue chip stocks, the stable, well-established players. Then you have mid-cap companies ranked between 101 and 250, offering a balance of growth potential and stability. Finally, small-cap companies ranked beyond 250 are the riskier but potentially high-reward investments. They're the emerging businesses with massive growth potential, but also significant volatility. Speaking of volatility, you've probably heard the terms bull market and bear market thrown around. And here's what they mean. A bull market is when stock prices are rising or expected to rise. Everything's optimistic, investors are confident, and money's flowing in. Why a bull? Because bulls attack upward with their horns. A bear market? That's the opposite. When stock prices fall 20% or more from recent highs over a sustained period. Bears swipe downward with their paws, hence the name. These aren't just fun terms. They describe the entire sentiment and direction of the market. And while we're on animal terminology, let me give you a rapid fire of other trading animals you'll encounter. Pigs are greedy investors who take excessive risks, chasing quick profits. And as the saying goes, bulls make money, bears make money, pigs get slaughtered. Chickens are the nervous investors who panic and sell at the first sign of trouble. Rabbits are the quick traders who jump in and out of positions rapidly. And here's a strange one, the dead cat bounce. This refers to a temporary recovery in a falling stock's price. The dark humor? Even a dead cat will bounce if it falls from high enough, but it's still dead. It means the recovery is short-lived and the downtrend will likely continue. Now let's understand how you actually place trades. When you want to buy or sell, you have several order types. A market order is the simplest. It executes immediately at whatever the current price is. You prioritize speed over price. A limit order lets you set a specific price. You'll only buy if the stock hits that price or lower, or only sell if it hits that price or higher. This gives you control but doesn't guarantee execution. Then there's the stop-loss order, which is crucial for risk management. This automatically sells your stock when it drops to a certain price, limiting your losses. Professional traders swear by stop-losses because emotions can destroy your portfolio faster than any market crash. Here's something that confuses everyone at first: bid and ask prices. The bid price is the highest price a buyer is willing to pay for a stock right now. The ask price is the lowest price a seller is willing to accept. The difference between them? That's called the bid-ask spread. A narrow spread means the stock is liquid, easy to buy and sell. A wide spread means it's harder to trade without affecting the price. Now for the analytical side. When people talk about valuing stocks, they're usually referring to fundamental analysis ratios. The PE ratio, or price-to-earnings ratio, is king here. It tells you how much you're paying for every rupee of the company's earnings. If a stock has a PE of 20, you're paying 20 rupees for every 1 rupee the company earns annually. A high PE might mean the stock is overvalued or that investors expect high future growth. A low PE might indicate it's undervalued or that the company has problems. The P/B ratio, or price-to-book ratio, compares the stock's market price to its book value. Basically, the company's net worth divided by its shares. It's especially useful for analyzing banks and companies with lots of physical assets. APB above 1 means the market values the company above its book value, while below 1 might indicate undervaluation or trouble. EPS, or earnings per share, shows how much profit the company makes for each share. Higher EPS generally means better profitability. And dividend yield tells you what percentage return you get from dividends alone. It's calculated by dividing the annual dividend by the stock price. Let me hit you with 2 major analysis approaches. Fundamental analysis is all about digging into a company's financial health, studying balance sheets, income statements, cash flows, management quality, competitive advantages, and industry position. It's for long-term investors who want to understand the business behind the stock. Technical analysis, on the other hand, studies price charts, patterns, and indicators to predict future movements based on historical data. Technical traders look at candlestick charts, support and resistance levels, moving averages, and volume to time their entries and exits. Support is a price level where a stock tends to stop falling and bounce back up. Think of it as the floor. Resistance is where it tends to stop rising and fall back down, the ceiling. Now for the big picture, market indices. These are like report cards for the overall market. In the U.S., you have the Dow Jones Industrial Average, which tracks 30 major companies, the S&P 500, which covers 500 large companies and is considered the best overall market indicator, and the NASDAQ Composite, which is heavily weighted toward technology companies. In India, our main indices are the Sensex, which tracks 30 companies on the BSE, and the Nifty 50, which tracks 50 companies on the NSE. These indices give you a snapshot of how the market or specific sectors are performing. Here's a term that sounds more complex than it is: portfolio. Your portfolio is simply the collection of all your investments, stocks, bonds, mutual funds, whatever you own. Diversification is the strategy of spreading your investments across different assets, sectors, and geographies to reduce risk. The classic advice: don't put all your eggs in one basket. If one investment tanks, your diversified portfolio cushions the blow. Speaking of different investment types, let's talk beyond just stocks. Bonds are essentially loans you give to companies or governments that pay you interest. They're generally safer than stocks but offer lower returns. ETFs, or exchange-traded funds, are baskets of stocks that trade like individual stocks. They give you instant diversification. Mutual funds are similar but are actively managed by professionals and typically have higher fees. Now for the intimidating world of derivatives, futures and options, often called F and O. These are contracts based on underlying assets. A futures contract obligates you to buy or sell an asset at a predetermined price on a specific future date. Both parties must honor the contract. An options contract gives you the right, but not the obligation, to buy or sell at a predetermined price. There are call options, which give you the right to buy, and put options, which give you the right to sell. These instruments can be used for speculation or hedging, protecting your portfolio against losses. Here are some terms that describe different trading styles and strategies. Intraday trading means buying and selling stocks within the same trading day. Positions aren't held overnight. Swing trading involves holding positions for several days or weeks to profit from expected price moves. Dollar cost averaging is the strategy of investing a fixed amount regularly, regardless of price. This removes emotion and timing from the equation. Averaging down means buying more shares as the price falls to lower your average purchase price. Risky, but sometimes effective. Let's talk liquidity and volume. Liquidity refers to how easily you can buy or sell an asset without significantly affecting its price. High liquidity means lots of buyers and sellers. You can trade quickly. Volume is the number of shares traded during a specific period. High volume often confirms price trends, while low volume might signal weak conviction. Here are some terms related to corporate actions. When companies make profits, they can distribute some to shareholders as dividends. This is passive income for investors. Sometimes companies issue bonus shares, free additional shares to existing shareholders based on their holdings. A stock split is when a company divides its existing shares into multiple shares to lower the price per share, making it more accessible to small investors. The total value remains the same. It's like cutting a pizza into more slices. Now for some risk-related terminology. Volatility measures how much a stock's price fluctuates. High volatility means big price swings, more risk, but also more opportunity. Beta compares a stock's volatility to the overall market. A beta of 1 means it moves with the market, above 1 means it's more volatile, below 1 means it's more stable. Leverage involves borrowing money to increase your position size. It amplifies both gains and losses. Margin trading is when your broker lends you money to buy more stocks than you could afford with just your capital. Let's end with a few more essential terms. The 52-week high and low shows the highest and lowest prices a stock traded at over the past year. Many traders watch these levels closely. Market capitalization categories we covered, but remember, megacap refers to companies valued above $200 billion. Blue chip stocks are shares of large, well-established, financially sound companies with a history of reliable performance, the safest bets in the market. Inflation is the rate at which prices for goods and services rise, eroding purchasing power. It affects your investment returns. Interest rates, set by central banks, influence everything from bond yields to stock valuations. And recession is a significant economic decline lasting more than a few months, typically defined as 2 consecutive quarters of negative GDP growth, usually bad news for stocks. There you have it. Your complete beginner's dictionary of stock market terminology. From understanding what a stock actually is, to navigating bull and bear markets, to analyzing companies with PE ratios and managing risk with stop losses, you now have the vocabulary to understand financial news, investment discussions, and most importantly, to start making informed decisions with your own money. But here's the thing, knowing these terms is just the beginning. Real learning happens when you start applying them. Open that DMAT account, start with small investments, practice analyzing companies, track your portfolio, and most importantly, keep learning. The stock market rewards knowledge, house patience, and discipline. If this video helped demystify the stock market for you, smash that like button and subscribe for more investing content that actually makes sense. Drop a comment below telling me which term confused you the most before watching this video, or if there's any term I missed that you want explained. And hey, share this with anyone who's been too intimidated to start their investing journey. Let's build a community of informed investors together. Remember, the best time to start investing was yesterday, but the second best time is today. See you in the next one.